Hey everybody, Brian Canary here. This is Mortgage Money Monday, and so we're going to talk about mortgages and money and how it can help you. And I got some great news today because I've got a story that just came out. It's been widely reported that when they measured home values in the United States, this is from the second quarter of 2016 to the second quarter of 2017, and we're now in end of September 2017, but they found that the home values in the United States have risen over that 1 year period, and pretty substantially. I think it was like around over a 10% increase. And the actual numbers were the average increase in the United States was $13,000 per home, which is pretty nice. Every state was a little bit different, and like for example, out west it was much bigger. The Washington, Oregon, and California were like 21,000 through 40,000 for Washington, and 21 for Oregon. I think California was about 30. So there were some much bigger increases out west. And then you had a few states that were real small, and then in the Midwest was solidly, in the probably in the over 3,000, but maybe in the $5,000 to $15,000 range, all across the Midwest. So Indiana, for example, had an average increase of $7,000 per home. Ohio was like $6,000 per home. So congratulations, if you're a homeowner, you just got richer over the last 1 year period, to the tune of 7,000, 13,000, whatever the number is for you. So that's good news. I guess I want to make the point to you that if you're watching this and you're already a homeowner, again, just congratulations, you just got richer. But if you're not a homeowner and you're thinking of becoming one, what are you waiting for? I mean, if you've got to get your credit in place, or you've got to get some things taken care of, work on that, get your down payment, get things taken care of, get the credit cleaned up. But you want to be a homeowner. This has traditionally been the way to build wealth in America for the middle class for a long, long time. And despite the housing crash, despite the fact that we had a housing crash, don't let that deter you from tapping into this potential wealth building opportunity. I mean, especially because what you don't understand probably is that if you want to get involved in investments at all, you can save your money in a mattress and you can put it in the bank. You can do stocks, bonds. You can do lots of things. But the one thing that you really can't really get, I mean, unless you're a Bitcoin gambler, and you can maybe do that too. You can get some leverage, but getting leverage is that's what the big Wall Street people do and the big banks do. Is the high rollers, they use leverage, and leverage is very dangerous in most cases because you can lose a lot, but you can also make a lot. Now, when it comes to home ownership, the leverage is not as dangerous. I mean, again, even if we had the housing crash and your equity amount for your home went down, that doesn't mean that you can't still live there and make your payments. So it's not super dangerous when you own a home, because you're actually living in the home as opposed to paying rent. You paying a mortgage versus paying rent. The upside to paying a mortgage, though, this is what I want to get to, and I'll wrap it up, is that you have tremendous amount of leverage, because whether you put down a lot of money or you put down a little bit of money, in this country, typically right now, the way it works, you can put down as little as 3.5%. In many cases, with an FHA loan or different types of loans will allow that. And even if you put down 5%, or 10 or 20, put down whatever you want. But I'm going to tell you the math. When you put down 3.5%, you've got about 28.5 times leverage. In other words, what I mean by that is, what is leverage? You can control an asset worth 28 times the amount of money you're putting down. So you're putting down a very small amount to control a large amount of asset. And then when that asset increases, your wealth just increased. So let's do a quick mathematical example, and I'll wrap it up. Let's say you have a $100,000 home, and you have to put down $3,500. That's 3.5%. Well, for $3,500, let's say that, like in this example we recently saw, in the United States, the average home price went up about 10%. Let's just say 10%. Your $100,000 house now, a year later, is now worth $110,000. Well, you only put down $3,500, and now you're $10,000 richer in 1 year. And what kind of a return is that? That's a tremendous return. That's approximately about a 300% return. I mean, you went from $3,500 to $10,000. It's a little more than a triple, or less than a triple. So, it's a tremendous return. I don't know what the math is off the top of my head, but if it was 200% return, that'd be $7,000, and then another $3,000 on top of that. So it's a great return. You can get your calculator out and figure it. But look, where else can you use that kind of leverage? It just doesn't exist really in any other investment that I'm aware of. Please contact me if it does. But that's the example I wanted to leave with you. It's great news. Homeowners are getting richer, and if you're a renter, get on this equity train now because of the fact that we have had a housing crash about 8 years ago. I'm sorry, it was actually in 2007. It's about 10 years ago now. Because we did have a housing crash, some of these houses, prices were depressed, and perhaps they got too hot. That's and there's a lot of reasons for that. We can go into that in a separate video. But now's the time where that corrected, and now we're starting to see some things kind of come back on the upswing again. So now would be the time, if you're on the fence, get on board and take advantage of that, and let's all get wealthier together, I hope. Thanks for listening.